Hello traders and welcome back to Pipeline Trading. If you don't understand how the market truly operates behind the scenes, then profitability remains nothing more than a dream. The real secret comes down to a single word: liquidity. In this session, I'll show you how to decode market direction using liquidity concepts in a way that's clear, practical, and almost mechanical. By the end, you'll know how to protect your capital and anticipate price movements with confidence. Think of this lesson as a roadmap to the market's engine. Once you grasp it, your trading perspective will never be the same. So stay locked in, because this could completely transform your approach. If you find value here, hit the like button, subscribe to Pipeline Trading, and drop a comment with your thoughts. Now let's dive in. The very first thing my eyes focus on when I open a chart is external liquidity. Why? Because it reveals the next destination price is likely heading toward before the move even happens. External liquidity sits outside the current trading range, above recent highs or below major lows. Comes in two forms: buy-side and sell-side liquidity. Buy-side liquidity is all the liquidity sitting above current price. For example, at a recent swing high, you will often find a cluster of stop losses from early sellers and stacked buy-stop orders from breakout traders. When price pushes into that level, those buy stops trigger, stop losses get hit, and suddenly a wave of buy orders flood the market. And who's waiting there to sell into that buying frenzy? Institutions. Smart money doesn't buy into buy-side liquidity. They use it to offload positions at premium levels. Sell-side liquidity is the opposite. Sits below price, usually beneath swing lows or fair value gaps. Here you'll find stop losses from long positions and pending sell stops. When price dips into those levels, sell orders trigger, pressure builds, and most retail traders panic. That's exactly when institutions step in, buying at a discount using the fresh liquidity provided. Understanding buy-side and sell-side liquidity is a game changer. It exposes where the market is hunting for orders and how institutions manipulate flow in their favor. But external liquidity is only half the picture. A magnet needs two poles, and the other pole is internal liquidity. Internal liquidity forms inside the trading range. It's where orders are filled, traps are set, and volume shifts. It usually appears as fair value gaps, inefficiencies, or order blocks. Think of it like this. External liquidity is the big target outside the range, but internal liquidity is the fuel station inside the range where price constantly refuels before its next drive. When you put them together, internal and external liquidity create the market's liquidity cycle. Price is always rotating between the two. It sweeps external highs or lows, then pulls back to rebalance internal inefficiencies. Sweep, rebalance, repeat. That's the natural rhythm of price. Once you see this, you stop chasing moves. Instead, you wait for the liquidity cycle to set up and align yourself with the next leg. Let's take a simple example. Price rallies aggressively into a previous swing high, external buy-side liquidity. The sweep triggers stops and buy orders, fueling the push. But once that liquidity is cleared, the market doesn't just keep climbing. It pulls back into a fair value gap left behind during the rally. That's internal liquidity being rebalanced. Once that gap is addressed, price then seeks the next external liquidity target. Maybe another swing high, maybe a resistance zone. Again it sweeps, again it pulls back, and again it rebalances. This cycle, external sweep, internal rebalance, is how smart money orchestrates market structure. So how do we predict where price is headed next? Will it sweep higher external liquidity or drop for the lower liquidity pool? The first step is reading order flow. Zoom out to the higher time frame or review the immediate trend. If price is breaking structure lower, odds favor a push towards sell-side liquidity beneath recent lows. If the structure is bullish, then buy-side liquidity above recent highs becomes the target. The second step is watching how price interacts with fair value gaps. This is critical. If price taps a gap and rejects it, that signals continuation in the original direction. But if it slices straight through without hesitation, that gap flips its role. It becomes an inverse fair value gap, acting as support or resistance depending on the breakout direction. For example, if price breaks clean through a bullish gap, it often flips into resistance, signaling downside continuation. That's your confirmation that sell-side liquidity is next on the menu. Every fair value gap has three levels: the upper boundary, the lower boundary, and the midpoint, known as the consequent encroachment. This midpoint is the most important. Price respects it, that's a strong signal of continuation. If it violates the midpoint with no reaction, the imbalance has failed, and the gap is likely flipping into an inverse zone.
Oh.
Here's the takeaway. Watch how price behaves inside the fair value gap. That behavior gives you the roadmap to the next liquidity target. What if price action is clean, with no inefficiencies inside the range? In those cases, external liquidity becomes the sole driver. Price will cycle directly between major highs and lows, sweeping stop orders without pausing for rebalancing. Only when new inefficiencies form does internal liquidity re-enter the picture. That's why it's so important to continually reassess. The market is always balancing efficiency with inefficiency, and liquidity is the compass. So let's recap. External liquidity sits above highs and below lows. It's where the stop hunts live. Internal liquidity is found in fair value gaps and imbalances inside the range. Together they form the liquidity cycle. Sweep external, rebalance internal, repeat. Reading order flow and watching how price interacts with FVGs reveals whether the next target is buy-side or sell-side liquidity. Once you understand this, you'll stop guessing and start trading with the market's real rhythm. Thanks for watching this masterclass with pipeline trading. If you learned something today, hit subscribe, turn on notifications, and let me know in the comments what topics you'd like me to cover next. Thanks for tuning in with pipeline trading. See you in the next update. God bless.